So how do exchanges work? What are exchanges? Why do we need them? And also why they are actually useful to us? In this video we will find the answer to all these questions because it's very important to understand the exchanges and to understand how they operate to be able to actually understand what's inside, because that's the door, and if we don't know the door, how can we pretend to know what's inside? Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. In one of the previous videos we talked about stocks and we said that stocks are listed on exchanges. But there are not only stocks actually, also bonds, futures, options, certificates, other types of derivatives, and all of those are listed on an exchange and they are traded on an exchange. So let's see in this video what exchanges are and how they work in a broad and general manner. So the main job of an exchange is to put in contact a buyer with a seller. That's what the exchange is supposed to do. Back in the days, this thing was done actually manually. You went on the exchange on the so-called floor and you placed your order, and there was an employee employed to take the orders of sellers and buyers and put them together manually. And actually exchanges are nothing new. The first modern type of exchange can be found in the 1600s in Amsterdam, and it's the Amsterdam Exchange, the so-called Euronext Amsterdam right now. Of course, this type of exchanges then evolved and now we mainly use computers. Actually, let me clarify, we only use computers. And so it's all computerized and the transactions are all computerized and the matching between sellers and buyers is all computerized. So what the exchange actually does, so the computer is taking our order, finding a counterparty and executing the trade. But if you think about it, we don't communicate with the exchange. I never heard someone calling the NYSE or calling the Nasdaq and asking them to place an order. That doesn't happen. We don't directly place our orders on the NYSE or on the Nasdaq or any other exchange. What we do is communicate with a broker, which is actually an intermediary, someone that stays in the middle between us and the exchange. That's the job of the broker, to stay in the middle. So what the broker is actually going to do is taking our orders, collecting them with all its clients and putting them on the exchange. The exchange is then going to do the trade between buyers and sellers and give back the securities, whether that's stocks or the actual cash in case of a sell. The cash and the stocks are then given to the broker, and the broker is then going to give the respective amounts of money or the respective securities to its clients, to the ones that bought it or to the ones that sold it. But why do we need exchanges? Why exchanges are useful for us? First of all, we don't need exchanges. There are certain markets, such as the ECN markets, that operate without exchanges. An example is the Forex market. On the Forex, we don't have exchanges. But these markets are normally more risky, and now we will see why they are more risky. So if we don't need exchanges, let's ask ourselves why it is useful for us to have exchanges. So why do they exist? First of all, as I said before, it's less risky to go on a certain exchange rather than a non-exchange or even a certain other exchange. We will see that in just a second. First of all, I want to say that exchanges help us to assure the quality of a company. That's because, first of all, there are some regulations that company need to follow. One of the regulation could be, for example, the $1 regulation on the NYSE, which means that the price of your share cannot drop more than $1 on the market. If it does, the stock gets unlisted. Another assurance is the fact that companies need to give quarterly reports, either quarterly or it depends on the companies and on the circumstances, but mainly they are quarterly reports, and this is mandatory if you want to get listed on the NYSE. And that's a big thumbs up for all the investors that need to see the fundamentals of a company and need to see what's going on with the company. Another thing is that the companies will have to respect other regulations which are higher than the exchange regulations, such as the SEC regulations. And even more, the SEC regulates some exchanges. One of the best examples is what we are seeing now. When the market drops too much, there is a SEC regulation which says that you cannot open more short positions. After a stock drops 10%, there is no way you can open short positions for a period of time on that stock. Another big advantage going away from companies and regulations into investors is the transaction assurance. When we trade stocks, there is not much difference between trading used stuff, used objects. But the thing that is different is that when we buy used objects, such as, I don't know, a lamp, a used lamp, you see the person face to face and you can actually see the money. If there is no money, you are bye-bye. The problem with shares is that we trade them across the world. And that makes it very, very difficult for us to be sure that the guy is going to give us the stocks or the shares. The exchange does exactly that. It takes the money, it takes the shares, makes the trades and gives back the respective amounts. So there is no way that an investor can scam you and not give you the respective amounts that you bought or the respective amount of money that you are owed because you sold. But also we talked about regulations previously, therefore the quality of an exchange matters. There are some exchanges that are called over-the-counter, which have very, very low regulations. Some of them don't even have regulations. These over-the-counter exchanges are places where you can find companies that cannot access these high standard exchanges such as the NYSE, the Nasdaq, the London Stock Exchange, the Milan Stock Exchange and so on. So on these over-the-counter exchanges, the regulations are very low. And guess which type of companies you can find on these exchanges? Penny stocks. That's correct. Penny stocks are normally listed on these over-the-counter exchanges since they do not meet the requirements of high standard exchanges. Therefore, it is a very good idea to stay away from over-the-counter exchanges and stay away from companies that are listed on over-the-counter exchanges. One of the many reasons, besides the quality of the stock and so on, is the fact that on these exchanges the volumes are very thin for the majority of stocks, especially when we talk about penny stocks. By thin volumes, I mean that the amount of shares that are exchanged within a day is very low. That means that the volatility, especially when a trader with a big amount of money enters the market, is going to be very high. And with the volatility, the risks increase. So we talked about the advantages because of the company, the advantages because of the investor. Someone is missing. The broker is missing. There is also an advantage because of the broker. Every broker has to meet certain standards in order to be accepted as a partner on the exchange. You cannot access the NYSE exchange unless you ask for it. And if you ask for it, they will screen you as a broker and they will see if they can accept you or not. This is why when you go online, you will see a bunch This is why when you go online you will see a bunch of brokers for Forex and CFDs. That's because these two markets do not require an exchange and it's very easy to open a broker. But when you have to open a broker, especially if you want to be a scam broker, on a proper stock market, it's very expensive since you need to pay fees, you need to regulate yourself, you need to meet certain standards. Therefore, scamming people, it's very much more difficult. If you want to scam people, open a brokerage on Forex or CFDs. Therefore, if you are an investor and the broker only offers CFDs, run away as quick as possible. In the next video, I'd like to talk about indices. I'd like to say what indices are, how they are created, who creates them, but also how we can use them. There are some ways we can use indices. Let's see those ways in the next video. So if you don't want to miss out on any further video, I will highly suggest that you subscribe to the channel immediately, so again, you don't miss out on any further video. Also, if you enjoyed the video, please leave it a like. This is one of the few ways that I have in order to see if you like the video and therefore keep posting. Nonetheless, I will see you in the next video. Together with stocks, bonds are probably one of the most well-known and most used instruments, financial instruments, that we have in order to put our money in the mechanism of economy that we talked about in previous videos. So let's see in this video what bonds are, how they work, but also